Welcome to a Wiser Retirement Podcast, where we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Guiding you to financial freedom today is my co-host, Missie Beach. Today, we're going to talk about how to terminate a relationship with your financial advisor. Hey, Missy.
Hey, Casey.
So this is kind of a weird topic. I mean, why don't we talk about breakups?
Well,
right?
it happens.
I mean, we usually break up before Valentine's Day, right? Not after Valentine's Day.
True story.
So, there's a lot of reasons why you would terminate a relationship with a financial advisor. And this is something that comes up because we have a lot of new clients every single week here at Wiser Wealth Management. And very often we get the question of, okay, well, I want to transition here, but how do I leave where I am?
Yeah, people are always a little nervous to do that.
And rightly so. I mean, we do live in the South. We tend to be more passive aggressive than not, right?
Yeah, people want to have manners.
Right. I think so. I don't know about less so than maybe 20 years ago, for sure. But what are some of the reasons why you would leave your financial advisor? We kind of jotted down a few that we see, I think, the most. Number one is misaligned investment philosophies.
Oh, yeah. I mean, that's really the biggest one. And I think a lot of people don't realize that when they go into the relationship, that they're just like polar opposites. And they might be in some big active management philosophy when they're really just index investors at heart and just need a low-cost strategy to get them to their end goal.
Yeah, and I would say also too is there's a lot of I think what's the average advisor age in our business? I think it's in the late 50s, it could be early 60s, somewhere in there. There's just a lot of advisors that haven't kept up with the times, I guess. Mm-hmm. And so what we see is a lot of mutual funds. So we open up the account and there's a lot of actively managed mutual funds. Really, since I believe the early 2000s, I think specifically 2004, mutual funds have lost assets to exchange traded funds, ETFs, for every year.
Oh, gosh, yeah. I mean, and if you just look up the underlying expenses of any of those mutual funds, like say you're not a Wiser client and you've got an old account with mutual funds in it, just type in that, ticker into Google and look at the expense ratio.
Yeah.
I can guarantee it's not going to be low.
No.
It's going to be up there.
And then there's the hidden costs. If you're doing this inside of a brokerage account, that fund manager is making trades all year long. And what's going to happen is you're going to get a 1099 at the end of the year with capital gains. And so in 2022, which was a down year, double-digit down year for the market, people who had mutual funds were still getting capital gains tax bills. So you're paying income tax in a year that you actually didn't make any money. And so it's just not very tax efficient.
No, and I've worked at advisory firms before that were fee only, but had mutual funds in client portfolios. And trust me, that's a bad conversation to have with clients when their portfolio is down for the year and yet they're recognizing income on a tax return for money that they didn't see in their portfolio. And
it really should be the opposite of that. You should be able to use tax loss harvesting to be able to create tax credits during those years, not be subject to a fund manager offloading something with a low cost basis in a down year. So anyway, that kind of goes along with the misaligned investment philosophies. Underperformance, this also is kind of a subset of misaligned investment philosophies. So typically, if you have an active management philosophy, so you own a bunch of stocks that they pick for you, but those stocks kind of trade in and out. That's an active strategy, or a lot of the mutual funds, if they aren't indexed mutual funds, are going to be active strategies. And a lot of times in the short term, when you think that you need active management the most, is when it lets you down the most.
Oh yeah.
And so in the short term, we don't see fund managers outperforming in volatile times. And in the worse funds, we see them actually underperform the market in those cases. They made the wrong bet.
Oh, yeah.
Yeah.
And those that do outperform don't do it consistently year after year.
No,
so when you see those little mutual fund ads, maybe they outperformed the index one year.
Right.
but it's not like for their 30-year since inception.
Correct.
So it's very misleading.
That's kind of that's a little bit of the downside to passive investing. And to be clear, we do have some active management inside of our portfolios. It's a very small percentage, but it is there because there's a purpose for it.
Right.
But, to be fair, it's kind of boring to invest in index funds, but statistically you win. The chance of any active manager beating the S&P 500 over a 20-year period is 2%. Over a 10-year period, it's 6%. And over a 3 to 5 year period, you might get 30%, have a 30% chance. Yeah. So it's just really, really hard to play that game. And I could tell all of our clients, there's no secret sauce to investing. We're a financial planning firm that does asset management. And so therefore our value is not in portfolio stock picking. Our value is in the whole holistic plan and then the portfolios that we build to match those plans long term. So underperformance really shouldn't be an issue if you're buying the average that nobody can beat, basically.
Exactly. And who's going to bet their entire investment net worth on active management if it's not going to beat the index over the long run?
Exactly. Not returned emails and phone calls, communication issues.
Oh my gosh.
So I would honestly say that we see some pretty decent portfolios, not horrible portfolios. But you have to remember in larger firms, an advisor is going to have upwards of 3,500 clients. And so after they've sold you that portfolio, they really aren't really gaining much more out of the relationship. And so they have to move on to the next victim.
Good word.
So it's when you email them, it's pretty common not to have a response. There was a situation a long time ago. We took some clients to a golf tournament. I guess it was at Eastlake. It had to have been. And I had like 6 extra tickets, and I had an advisor friend in my Sunday school class that worked at a bank. And I said, "Hey, I've got these 6 extra tickets. If you want to find some clients to go, it's the final round on Sunday, and there's a VIP 10 access." And he's like, "Oh, thank you so much." A few hours later, he calls me back and he says, "I don't know any clients of mine that like golf." What? I was like, "How many clients do you have?" He's like, "About 3,100, but I really don't know them that well."
Oh, see, that tells it all right there.
It's like, wow.
3,100 clients. He couldn't find 6.
He wouldn't know if they walked down the street.
That's awful.
So, high or unexpected fees. I would say that if you're not at a fee only firm, then you probably do have high fees. You just don't know it. There's so many ways to hide fees when you're not a fiduciary.
Oh yeah, because when we get statements of new clients, it's hard to dissect those statements and figure out where the fees are being charged. Is it monthly? Is it quarterly? Annually?
I think Edward Jones, their fee disclosures upwards of like 20 something pages. Mm-hmm. It's very confusing to figure out. And I know the advisors know, but they're going to work really hard not to tell you. There's one here locally that likes to tell his clients, "You don't pay me, the fund companies pay me." I'm like, "What?" What do you mean the fund companies?
The fund company.
Yeah, I know. It's like, who do you think's paying the fund company? It's coming out of your performance. So
talking about hard to break up with.
Right.
You just named one.
Yes, exactly. So it's pretty simple. If you're in mutual funds, you're paying some type of a 12B1 fee, and then a lot of firms charge a fee on top of that for having your assets at the firm, and then there could be some type of commission on the front end. Mm-hmm. So in a traditional setup, if you're at a large like a Merrill or a Wells Fargo, then there's many different types of accounts that you could open up. You can open up an individual stock account. You're probably paying over 2%. Mm-hmm. You could open up a wrap account. So they're charging you like 1% or 1.5%. Mm-hmm. But then it seems to me from what we see on statements, there's also kickbacks from the mutual funds, right? mutual fund companies.
Yeah.
So that's an additional fee. So you're still close to 2.5%. So it really adds up, and it's really hard to tell, exactly what the fees are. And those advisors really aren't equipped to answer those questions because they're all trained on how to avoid the conversation.
Oh yeah. Why would they want to disclose that?
Well, in our world, in the fee only world, your fees are pretty straightforward. They're all disclosed on a quarterly basis on your invoice.
Oh yeah.
So,
and that's what I tell all of our
it's all right
clients.
there.
I'm like, that's how we sleep at night. It's
Right.
so transparent. I have nothing to hide.
Exactly. And it's up to us to provide that value for what that fee is. Let's see. Life changes. Yes, we get, I guess on your side for sure, the divorce.
Oh, yeah.
Typically you break up with the financial planner, although we've had a few
we keep them.
Or divorces where we keep both of them.
Yeah. We'll just split them up.
Right. Desire for a different service model. That kind of goes back to what we were talking about earlier. A lot of people will leave their financial advisor to come to Wiser, really because of our unique planning process. And it's not that the other firm was doing bad as far as portfolio management, but there was no direction. They were just managing assets. They didn't really assemble a full strategy for going forward.
Or they did, quote, a plan, but it was 10 years ago. And I'm like, well, how's that a plan? How's that working now? Are you still on track? And they're like, I don't know. It's 10 years ago.
Advisors will often do that. They'll do one financial plan and call it done. And you can't do that. You have to do one plan and then monitor that plan and, check in every 6 months to a year to make sure that plan is still going correct.
And that's what I explain to clients. That's why we never print a plan out, because it's not the right plan as soon as it's printed, because the market has changed. Their salary might have gone up. They might have changed something about their college decision or something. So there's no point in printing out that 80-page plan and sliding it across the table saying, here you go, Mr. Client. Have a great life.
We used to do that a long time ago.
Yeah, because that was
80-page plan.
Yeah, the way it was done.
There were no portals or
No.
anything like that.
We've evolved into the digital age.
All right, so you have your reasons. You decided that you're going to leave your advisor. The next thing you might do is take a look at your contract or agreement. Now, if you're at a big brokerage house, you have no idea what that is because it's hidden from you. It's you signed a bunch of stuff when you open an account, you'll never see it again.
No.
But the theme here is you should never, I can't think of any situation where you can't get your money out of a firm, with the exception of annuities. So if you've been sold an annuity, you can leave that advisor still, but someone's going to have to house that annuity for you. Now, we have an annuity rescue program here, so we can get the annuity transferred away from an advisor and held in an account where you can use Vanguard index funds. We really don't want to use it at all, but we have to have some way of rescuing those annuities from those high fees. So anyway, that's there. Or if you have a surrender period, sometimes you have to leave it for a little while.
Yeah.
So some of these annuities have 14 plus year surrender periods.
Crazy.
Especially the not fixed annuities, the indexed annuities.
Oh, yes.
Have a pretty long runway before you can get your money back. Where a fixed annuity, typically once it's annuitized, you would just leave it there. It's not that big a deal. Fixed annuity is like a big CD. You just don't get your money back.
Exactly. But some of the really old annuities,
the variable annuities
might have some riders where it makes sense to retain them. Yeah. So if you're going to some advisor that's not a fee-only fiduciary annuity or provider, they would tell you to take that annuity and roll it to an IRA.
Right.
But for example, we had one client where, sure, we could have gotten a great amount of assets under management if we had just told him that. But in his case, it made sense to leave it with the annuity company because it had this great income rider benefit.
Right.
So we said, hey, Mr. Client, you just need to leave it there and let it ride, even though he's outside of the surrender period. So that's where fee only really comes into play, doing the right thing for clients at all times.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
Generally speaking, when you want to leave a firm, you don't have to worry about any fees leaving. Might be $50 or something like that
to transfer the account out. And that's the custodian that's charging that.
Correct, not the advisor. That's true. So another way, I guess another roadblock we often see is, well, the market's down, and it's not currently, but this happens a lot when the market's down. The market's down. I'm going to leave it there, and when the assets rebound, then we'll transfer it over.
Oh, yeah. A lot of people think that.
And I understand they don't want to take losses, but you have to understand when you're leaving a firm and you're moving into like our firm, which uses Charles Schwab as a custodian, we can really pretty much hold anything. So we don't ever liquidate and move. What we do is we move in kind.
Yes.
So if you had Coca-Cola stock there, you're going to have Coca-Cola stock here. And once it's here, and you wait about 2 weeks after, we get all the cost basis information. So now we understand what you paid for it. And then a game plan is assembled. So we sit down with Andrew when we go through, we decided, okay, this is the game plan of how we're going to handle these individual securities. You would never just liquidate the portfolio and move it over if it's taxable.
Right. And that's what a lot of clients are fearful of.
That's what they're fearful of, but they have a right to think that, because I think most advisory firms will force you to liquidate and move over. And that's not the prudent thing to do. Why? Like, for example, if you had IVV, which is the S&P 500 by BlackRock iShares, but we use VOO for the S&P 500. Why the heck would you sell IVV to buy VOO and pay a tax?
Oh, I know. Yeah, exactly.
Yeah, and some firms, this is the fund we use.
Not our preferred mix. So.
Right, not our preferred mix. So what we do is we're able to go in and say, okay, we're going to keep these 5 securities because they're similar to what we're using. And then we tell our computer, hey, these are the same as. And so now we can start rolling forward in our model, but we're using securities from your old portfolio to make that work for you, because we don't want to cause any negative tax consequences.
Absolutely.
And then individual securities now we can use, if they're large enough, we can use direct indexing. So instead of using ETFs, we skip the ETFs, we go right to create our own index, like an ETF.
Yes.
But instead we take your stock and we use your stock to build that index. And then as you own, 500 companies, not all of them are profitable every year. So you tax harvest some of those losses, and then you're able to kind of sell off those old securities that you had to work them into the new portfolio. So there's a lot of tax efficient things you can do.
Oh, yeah.
But most firms don't work that way because it's not easy.
No, it takes time to analyze and figure out where you can re-engineer the portfolio to work with what a client already has in the most tax efficient manner. Which
is the benefit of a boutique firm. If you're at a Merrill, or if you're a big firm, you're just a number.
Yeah, I know.
The advisor is just a number. That's more important. Right?
Yeah.
So in the end, they're not going to be able to really customize that portfolio. You got to be black or white. You can't be in the middle.
No.
So another thing to think about is you don't have to communicate to the advisor you're leaving.
Oh yeah. People are kind of deathly afraid of that in some cases.
So if you want to avoid it, you can just avoid it if you want. Now,
True.
Some people don't want to do that. They feel like they owe them something. I would want a client to tell me, we don't lose clients very often, but I would say, this is why I'm leaving.
Right. Yeah. Let me know so I can improve my process.
Right. So what most people will do is they sign the paperwork to transfer, So for instance, here you would open up Charles Schwab accounts. You sign transfer form. That transfer form is delivered by Charles Schwab to the old company, wherever you are, the old advisor's company. And then basically there's a hold put on that account so no trades can be made. And then a few days later, the two companies talk, and then all the transfers happen from old company now into new company, new brokerage. And that's it. So the account just kind of disappears off their platform, and then off you go.
No harm, no foul.
Right. Now, some people will ask me to draft a letter for them. And so the letter goes something like, "Dear Mr. or Mrs. Advisor, thank you for your service and helping me with my portfolios in the past. I've decided to change to a fiduciary fee-only financial advisor who's now going to take over my asset management." And then it's really that simple.
Yeah, you don't need a ton of details.
And I've had some people go, "Oh, I just like this is a friend of mine. I know him so well." And they'll call them and they'll say, "Hey, look, I need more in-depth financial planning." And usually most people don't do in-depth financial planning. So they're usually like, "Well, I don't do that." And it's like, "Well, I've decided to move here." And everyone's kind of like, "Yeah, okay, that's what you need. I don't provide it." So that makes sense. So it's not as hard as you think it is.
No, it's really not, because most of the big brokers don't do the financial planning. They're not going to review your home and auto insurance and look at your life insurance
right.
needs.
Unless they're selling life insurance.
Oh, well, then they'll be more than
Right.
happy to. Or they'll just kind of throw it out there and be like,
Right.
$1 million whole life.
We had a Delta pilot not too long ago that called me up and he said, "Hey, I need to hire you guys to do financial planning because I met with this Northwestern Mutual guy, and he told me I shouldn't contribute to my 401k and I shouldn't start the market-based cash balance plan. And instead I should just put $6,000 a month into a whole life policy."
Oh, $6,000.
I was like, I said, he went back to his office that day and "Guess what? I got a prospect that's going to put $6,000 a month into his whole life policy." And if he had done that, there'd been that would have been detrimental to the pilot.
Yeah.
But if he had done it, the Northwest Mutual agent, there'd been no consequences because he would have been suitable technically.
Yeah.
So yeah.
Past that fiduciary bar,
Exactly.
which is so low. That's what people don't understand. Like fiduciary and fee only are not really interchangeable. You
Right.
know, like brokers can be a fiduciary, but not really looking out for the client.
No, still not looking out for the client. Yeah. I mean, that goes back. We've talked about this in other podcasts, but they're just the three different business models. You have the Edward Jones typical business model where, you invest in a mutual fund, they collect 4.25% commission.
And clients are not aware of that. They are mad when you point out to them like, "Oh, well, this fund they put you in, there was a front end load.
Right.
They made almost 5% of what you put in there." So
you had 5% loss from day one.
yeah.
And the other business model is it looks like wealth, like us in wealth management, but it's basically a wrap account that you're paying just one flat percentage for everything. But then those people, in some cases, can be fiduciaries, but they're only fiduciaries in the planning process. And once they're done with the planning, then they turn into salesmen, and they're not fiduciaries. And then how do you know that? And there's no disclosures for that. It's saying that, okay, I'm no longer acting as your fiduciary.
Such a blurred line.
So that's called the fee-based model. And what happens is people leave these big brokerage houses and they go to work for themselves, independent firm, but they bring their same bad habits. They don't change their tactics. They just wanted more money.
Yeah.
That's why they leave. It's about compensation.
To go out on their own. Yeah. Why pay the overhead of Merrill or
And
Wells?
then you have the fee only model where you're a fiduciary the entire time. And that's the part that only 4% of the business operates this way, which is really frustrating. I mean, it's good for us from a marketing standpoint. Some days I feel like it doesn't matter because no one understands it anyway. The client doesn't understand it.
True.
I think there's safety at being at a huge firm. And there's really not. As I was trying to explain it to somebody recently is, look, right now we operate in a team of 5. You're touching all 5 of us in different parts of the planning process. You go to a big company, you're talking to maybe one person with an assistant.
Yeah.
And they're in a silo. they're not working. They have resources that they could go and talk to about your particular case or pawn you off on this asset manager or this person who does estate planning. But really, you just have one person.
Yeah, exactly.
So you're only good as that one person. Where in a boutique firm, you're getting more of, you get more of the holistic approach.
We know who you are.
Well, that too.
We know if you like golf or not.
Yeah, exactly. So it can be very confusing to the public. In the UK, Australia, China, you cannot sell a product and get paid by that product. Where in the US, that's like the American way,
Messed up.
Yeah. And it's there's been times to change it. The Republican Party is very favored toward the special interest groups from the big insurance companies. So there's been a few times where, like when Obama was in office, he said, okay, it's going to be a fiduciary standard for all. That lasted a quarter or two. Yeah. And then some things passed, but then the Republicans defunded it. So it's been kind of frustrating from a political standpoint because the party that probably most of us are voting for in the South, it's that same party that is financially suppressing us from a pure fiduciary standpoint. But if you think about it, if it actually went through and there was a pure, not a watered down fiduciary standard, think of all the annuities that could no longer be sold.
Oh, wouldn't the world be a better place?
All the life insurance that wouldn't be sold. So you understand why they spend millions and millions of dollars in lobbying efforts, because they're making so much money on these products that, for no reason,
no reason at all.
So anyway, once you sign accountants and you separate from the advisor and the money shows up here, that usually takes 2 to 3 weeks to do that process. And then after that, it's kind of smooth sailing. Once you get the planning done and once you get the accounts allocated, then it kind of turns into a monitoring situation.
Exactly. That calendar year, you would have 1099s from your old custodian and your new, and no big deal.
Right.
Your CPA doesn't mind. It's just couple entries instead of one.
Then after that, it's all everything on one 1099 for each per account. Yeah. So anyway, hopefully that was informational on the transition. I think a lot of people think of themselves as being loyal. I think ultimately you have to be loyal to your best interest.
True. And another thing to point out is that while Wiser has a really high retention rate, that's not the case of these other providers.
Correct.
So they are used to turnover and churn in their client base. So they're not shocked when someone says, hey, I'm out the door, or they see assets going out.
I believe that the average retention is like 5 years at most brokerage.
Oh, wow. That's really short.
Yeah, I think that's correct. I'd have to, and that could be an old number.
Well, that kind of makes sense. That's when clients wake up and realize, like, hey, you don't really know me. You're not really paying attention to me anymore. Like, what's changed? What do I need to do to reposition? My whole, family structure has changed. My kids are gotten older. Right. I'm 5 years closer to retirement. What do we need to be looking at? And the advisor's just kind of silent.
Right.
Okay. I'll buy your stat.
Yeah. We have a 99% retention rate over that same time period, 5 year period.
Which is crazy.
Yeah. So, well, we have a couple of other episodes. Episode 118, what to look for in a financial advisor. If you want to dive into that a little more, we do have a YouTube channel, A Wiser Retirement, where we talk about financial planner versus financial advisor. If you want to schedule an appointment to talk with us about your financial planning and your future, you can do so by going to wiserinvestor.com and click on the schedule button. There should be a link for that in our show notes as well. Thanks for your time today, Missy.
Thanks, Casey.
And we'll see you guys next week.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out.
This episode was produced by Edward Resendez.